It's our third lecture. It's on topic is interest rates. On the last chapter, we looked at time value money, and we did a whole lot of moving money through time at a given interest rate, but we didn't really talk about why the interest rate is what it is. In this chapter, we'll kind of look at why interest rates are what they are. So I have a very, very short outline here for this chapter: why do interest rates change, and then term structure of interest rates. We'll look at what are the theories behind what makes interest rates what they are. Why the term structure kind of fits under that category. That has to do with something we call the maturity risk premium, which is why are long-term interest rates different than short-term interest rates. So for starters, let's look at a thing called the Fisher equation. The Fisher equation has been around for about 100 years now. It's a basic equation that breaks up what we would call the risk-free rate into two factors. The risk-free rate is some investment that you have available to you that is least risky of all others. So in the U.S. we think of it as our government's bonds and bills. Really we think of it as the government treasury bills, which are short-term government debt instruments. Our government probably is least risky investment we have available to us, because even if they get in trouble, they could probably print money to pay off their debt, meaning they're probably going to always pay off their debt. That's not necessarily true. You could have some kind of political stalemate or something. There's a thing called political risk, where the different political factions in the government can't get together, and so they can't pay off their debts because they didn't get the right laws passed and whatnot. So it's certainly possible that our government debt is not risk-free, but it's hard to imagine a security that's less risky than the government, again, because the government has taxation power, the police power, they have power of law, and they have the power to print money. So they're probably going to be able to pay off their debts before anybody else can pay off their debts. So we think of them as the risk-free rate. With the going rate on treasury bills, which are short-term government debt, we think of as the nominal risk-free rate. Whatever that risk-free rate is, we take as the risk-free rate. We can break that up into two factors. The nominal risk-free rate is a factor of the real risk-free rate plus inflation expectations. Let's start with let's start with inflation expectations. That's kind of the easier one to understand. Inflation expectations are the change in the value of purchasing power. So, for example, we have a thing called the CPI, the Consumer Price Index, which measures the overall price level of a basket of goods and services that the average consumer buys: bread, milk, gasoline, things like that. That's going to go up year to year, usually on the order of 2 to 3% here. It's different in different countries, but number one, you need to be compensated for that. Then number two is you have what we call the real risk-free rate. That one's a little more abstract, but in order to understand what the real risk-free rate is, you need to imagine you were borrowing and lending in terms of real goods and services. So let's say I loaned you 100 head of cattle, and I said next year you have to give me 103 head of cattle back, meaning you have to give me 3 more head of cattle than I gave you. That would be a 3% real interest rate. I want to have 3 more head of cattle per 100. And that's going to be affected by what? Let's imagine what affects the real interest rate. What underlying economic factors affect the real interest rate? It's driven by, we usually think, productivity. So in the head of cattle incident, it might be driven by weather or things like that. If the weather is really good, and everybody knows the weather's going to be really good, then the cattle are going to reproduce well because they're going to have more grazing time and things like that. And so maybe you ask for 105 head of cattle instead of 100. If you know the weather's going to be really bad and nobody can put their cattle out to pasture, yada yada, maybe you only ask for 102 head of cattle. And so you only get a 2% return instead of a 5. So it's also, if you take it, abstract it outside of the cattle example, just take it to the general economy. If you have a more productive economy, there's an opportunity cost, meaning that if you know the economy is going to generate X amount of return, you're going to require that. So if the economy is really productive and all industries are doing well, you're going to require a large real return, meaning you're going to want to get paid back a lot, because if you don't get that return from this investment, you can go put in another one that's returning a high amount. If the economy as a whole is not doing very well, then you don't have a whole lot of opportunity to put your money anywhere else, and so you're going to have to accept a lower return. So we usually think the real risk-free rate's driven by productivity. Inflation's the other factor. So put that in the head of cattle example. If I wanted 103 head of cattle per 100, plus, let's say I thought the price of cattle was going to go up 4%, how much would I ask if I was loaning money directly instead of loaning the head of cattle? I would ask a 7% return, not a 3% return. I want 3% more cattle, plus I want my 4% return because the price of cattle went up. That's called the Fisher equation. It's the starting point of understanding why interest rates do what they do. Two main factors. In a second, we're going to talk about, you can add over here, if you put a plus on here, rates also have a risk premium built into them. But we're just talking about the risk-free rate now, so we're starting at a simple point. It's productivity plus inflation. That's really the starting point for why interest rates do what they do. So to give you an idea of the historical context of this, I have some charts that I'm going to show you in this lecture, because it's not real computation heavy. So we're going to look at several charts. This first one shows you nominal interest rates, real interest rates, and then applied inflation. I don't know how well you can read this or not on the video, but the blue line up top here is the nominal interest rate on long-term U.S. government debt. That's the information I have available to me. I can look up, it's really easy for me to get data on U.S. government debt and U.S. government corporate bonds and things like that. So we're going to take it from a U.S. perspective. But you can follow the chart a little bit and see what the nominal rate has done since 1997 is when this chart starts. I'll show you some data later in the course that goes much further back, even into the 1800s. So, but right now this chart just goes back about 15 years or so. So we have the blue line is the nominal rate on corporate debt. The red line is interesting. It's the rate on what we call TIPS bonds. Those are Treasury Inflation Protected Securities, is what TIPS stand for. Different governments, not every government, but the U.S. government, England does the same thing, they offer them, and several other countries do. They're called, they're inflation protected securities, meaning that their payout, the interest payments they make adjust, and the principal amount adjusts by the level of inflation in the country. So if they have higher inflation in the U.S., that means the consumer price index goes up, the payment they have to pay out goes up. The important part is we can take the interest rate on TIPS bonds as being the real rate, because the rate that's stated on the bond is only if inflation doesn't change, meaning you know you're going to get inflation on top of whatever the red line says. So if you look at the blue line versus the red line, you can subtract the two to get the green line, which is expected inflation. So really the two important lines, if we're going to break down why interest rates change, would be these two. The red line being inflation expectations, the blue line being real interest rate, the real risk-free rate, which again we think is driven by productivity. Let's look at the red line for starters. Our Federal Reserve, our central bank, tries to keep inflation between 2%, which is this line, 3%, which is this line, and most central banks try to do that. They like to have a little bit of inflation because it spurs economic activity. You don't like to have deflation. If you're a business owner, the last thing you want is the prices of the goods you're selling going down. So if you have some inflation, that helps business activity, keeps business owners expanding and creating jobs and things like that. That's a little bit beyond the scope of this course, but let's just leave it at that. So let's look at this red line real quick. We had a recession in the late 1990s and inflation expectations fell. We came back from it. We had a severe economic crisis just like the rest of the world did in 2008, and you can really see that right there. And then it's come back, and now we're sitting right around that 2% level, which is where they like to keep it, between 2 and 3. It's been rising recently. If it gets close to 2.5, the Federal Reserve will start taking action to curb back monetary growth, which is good for inflation because it keeps it low, but it's bad for economic growth. Not as many jobs will be created. Now let's look at the blue line. The blue line did really well in the 90s, but it's done terrible ever since. There's a little spike right here, which we don't need to get into a whole lot about, but that was actually right when the economic crisis happened in 2008, and a lot of people think that was actually due to there was a risk premium put on U.S. government debt, just like everybody's debt. But it quickly corrected itself once the Federal Reserve and the Treasury took action. But it's interesting to note, again, what did we say drove the blue line? The blue line is the real risk-free rate. It's driven by productivity. It's now negative, meaning it's come down from around 4% in the late 90s. This is U.S. government debt. It depends on the country. But it's now negative, meaning it's come way low, meaning we actually have, in terms of real return on assets, negative. Meaning you're going to lose in terms of real. It'd be like I loan you 100 head of cattle and you have to give me back 99 next year. Meaning I expect to lose. The only return you're getting now is due to the change in the value of the dollar, which is you're not getting any more purchasing power. You're actually getting less purchasing power because you're losing on a real basis. A lot of that's driven by central banks, not just the U.S., but all around the world, have been pumping massive amounts of money into their economies to try to increase economic activity, and as they do that, they have to push interest rates lower. Japan dealt with this in the 1990s. U.S. is now dealing with it in the 2000s. We'll see where it goes in the future. That's a little bit beyond the scope of this course, but I just want you to really, basically, for this course, I want you to understand the Fisher equation, which is inflation plus productivity, or the real interest rate, is what is the nominal interest rate. Alright, let's move on. If I go back to I have another equation here. A couple equations. They're really the same equation. And I'm running a little low on time in terms of my lecture, so I might have to end this one. We'll do another one. But let's go ahead and talk about this real quick. Any given rate is the risk-free rate, nominal, which is a factor of two things we just talked about, productivity and inflation, plus a risk premium. And a lot of times we break that risk premium up into three things, which is here. So it's the rate equals the risk-free rate plus a risk premium, which is this whole thing. It's what we'd call the liquidity risk premium plus the default risk premium plus the maturity risk premium. I'm going to go ahead and end this video lecture here and start a new one because I'm running out of time. So catch you on the next lecture.